So there's this little place in the Caribbean that made the cover of Barron's, and on the front page of The Economist it was named the Greece of the Caribbean, and it has a little bit of debt and a problem, and we're going to talk about that. Our moderator is Mike McKee of Bloomberg, who I watched work diligently earlier this morning. He started at about 4 a.m. or so. And I'll ask Mike to introduce the panel and conduct a discussion of Puerto Rico.
David, we're still wondering why you don't hold this conference in San Juan, but in January. Interesting timing for the Puerto Rico panel today, because down in Washington, Puerto Rican officials are appearing before the Senate Finance Committee to explain their economic and political and debt situation. They're looking for help from the federal government, and right now it appears that people in Washington are rather skeptical about A, what they need, and B, what they can do for people in Puerto Rico. So we thought it would be very appropriate for us to get an update on all of those questions from the people who really know. Joining us on the panel today, as David said, a distinguished panel, with the exception of your moderator. Donald Rissmiller is the founding partner of Strategas. He's been the firm's chief economist since 2006, and prior to co-founding Strategas, Mr. Rissmiller was an economist and managing director at International Strategy and Investment. You know them as ISI. He also worked at the Federal Reserve Bank of New York. Michael Comas is a CFA. He's at Cumberland Advisors, vice president of research and a portfolio manager, including his responsibilities include research on current and prospective bond holdings, tax-exempt and BABs, as well as trading of tax-exempt and BABs on Cumberland's fixed income desk. He also works with the IT department and assists Bob Eisenbeis, whom many of you know, Cumberland's chief monetary economist, in developing their proprietary rating and forecasting model. So very useful for this project here. And Chuck Gabriel, 32-year veteran of political forecasting for institutional investors, the president of Capital Alpha. In addition to election risk and overall policy-related investment strategy, he specializes in trends and developments impacting the mortgage, specialty finance, and education sectors. I first met him, I think, when he worked at Prudential Financial years ago. He was ultimately the senior vice president and head of Prudential Equity Group in Washington before founding Capital Alpha. Let us, why don't we start with the general overview. Each of the panelists will make a presentation, and then I may pose a question or two to help assuage my ignorance, and then we will open it to questions from the audience. First, let's turn to Don and get kind of the 50,000-foot view here.
Well, thank you, Michael, and I appreciate the chance to be here and speak to the group. We did a presentation on Puerto Rico last year as part of the Global Interdependence Center series, and that presentation is up on the website interdependence.org. I've been tasked with talking about the economy in Puerto Rico, and not much has changed over the past year since I did that talk. So I'm going to summarize that, and you can see it on the web in its entirety if you want, but then spend my time, since it's short, talking about two economic items that I think can be useful when we look out from here. One is how we should judge debt-to-income ratios, and the second is when we consider optimal currency areas, is that relevant for this situation? So to start off, to give you the 50,000-foot view, we're talking about a relatively small economy, but a meaningful part of the global debt market. We're talking about an economy that's roughly 3 times the size of Rhode Island, Puerto Rico. And when we talk about this economy, two factors, geography and politics, come up quite quickly. Population's about 3.5 million. That population has been shrinking. So the individuals have American citizenship. Defense matters are handled by Americans. It's a Commonwealth status. There are different tax treatments, as has been discussed in prior panels, versus other jurisdictions. And that's how you can have a relatively small economy with a lot of debt. So There are some natural advantages, being an island, tropical marine climate, but there are also some natural disadvantages. Being an island means it's expensive to import things. There's been a historical lack of independence and a lack of control over currency and monetary policy. The size also creates vulnerability to money flows. So if we were to try and pick the point at which Puerto Rico, the economy, started to turn down, we'd really look around 2006. What's interesting is this predates the financial crisis. So there certainly have been problems in the global economy over the past decade, but the problems in Puerto Rico really predate some of those financial events. There was a change in tax treatment, removing some of the corporate incentives that had been there for some time that affected things like manufacturing. Companies began to relocate. So the Puerto Rican economy stagnated around then and really has not done much since. You've had a few attempts at recovery, but still you're starting from quite a low base. But despite that economic underperformance, some of the debt tax advantages remained. And so many individuals who are interested in being involved in Puerto Rico or derivatives of that look to insurance as ways to think about investing. What's happened most recently, and this is new, I'd say, since we last held this gathering, is you've introduced some what you might call competitors. Cuba would be an example here. So there are some natural advantages, but there are also some structural issues, especially when we think about taxes, that do matter here. What we also see when we consider the economy in Puerto Rico is that the labor force participation rate is not high and has been coming down really since some of these tax changes went into effect. Labor force participation is typically calculated as a ratio, and so this helps us because we may not calculate the data exactly right. We may not have the numerator or the denominator exactly right, but if we're making similar mistakes in both, you can have more faith in a ratio than you might in some individual statistics. So the fact that we have ratios like labor force participation falling tell us that something has changed over the past decade and is probably still an issue. You're looking at a labor force participation rate just over 40% for Puerto Rico versus the US mainland number, which is over 60%. Why is labor force participation so important? One, it would give you a broader group to pay existing debt. And second, the lack of labor force participation would mean you have an increase in those who are dependent on government. US laws do apply when we're talking about Puerto Rico. So if we think about minimum wage issues or benefits, those are all involved. Movements in labor force participation also tend to be slow and structural. So these things are hard to reverse. It may take a generation or so to see big changes in how people perceive work and the desire to work. The timely data we have from sources such as the Government Development Bank suggests Puerto Rico's economy remains weak. There is continued headline risk. And this is despite easy Fed monetary policy, which Puerto Rico would import. So let me spend the rest of my time talking about how this works. So when we think about a territory in this case, or a commonwealth, where you have a single currency, you're tying your monetary policy all together. So you can have a currency policy or an independent monetary policy, but you really can't have both. And this has come up around the world in recent years. This has come up when we think about Puerto Rico. Perhaps it has come up when we talk about what's going on in Greece and other areas of the global economy. If you have a flexible currency, that's one way of having an adjustment. So if you have too much debt, you have to get poorer. Sometimes it's easier to get poorer internationally than it is to get poorer locally. So if you have a flexible currency, you could devalue your currency and then not travel. And locally, that might not look a lot different right away. You don't have to have cuts in wages or cuts in prices. That's a strategy. But if you're in a currency union, or you have one currency, Puerto Rico has the US dollar. That's not available. And so when you think about interest rate adjustments, that has to come from the uber central bank, in this case the Fed, or in the case of the euro, the ECB. So you're removing one lever of adjustment, the currency. When do you want to do that? Why would you give that up? Well, there are some reasons you might want a single currency. The two criteria that typically apply are, one, if you trade a lot with your partners, and two, if you can move. And that movement would typically be movement of capital and movement of labor. So if you think about the United States, we have a lot of trade between states. So it makes sense that just because Tom Zazouris wants to come up here from Virginia, he doesn't have to change currencies. Or if I go down to DC, I don't have to think about borders in the same way we might in different countries. If you trade a lot, it helps. It reduces frictions. Movement is also important. Movement is important because that's how you take advantage of opportunities throughout the union. Movement of capital is necessary to build infrastructure, let's say, where it needs to be. Movement of labor is necessary to have workers where they are needed. And that's really what we're seeing in Puerto Rico. That's one of the reasons Puerto Rico is shrinking. The population of Puerto Rico is declining, and this may continue until the wealth of the territory can support the remaining population. The data we have right now says that's not yet. You had a population that was closer to 5 million, now you're down to 3.5 million. And it could keep going down as individuals who are citizens relocate to other places, other cities. And so that's likely to continue because you don't have those currency adjustments that would be possible. Then let me spend my final 6 minutes and 13 seconds talking about why debt to income matters and how that applies here as well as in other territories and countries around the world. Debt to income has to go sideways. That's a binding budget constraint over the long run. So if you think about why that has to be, if it kept rising, if that ratio again kept rising, debt to income, eventually interest costs would consume your entire budget. And so a ratio of debt to income has to go flat. For a country, you might look at debt to GDP, it's your proxy. And so you can have whatever size government you want, you can have whatever benefits you want, but you're going to have to pay for it. And when we think about debt, that's a function of taxes and spending. When we think about GDP or income, you would think that's going to be a function, because we're in nominal terms, of your price variable, your population growth, and your productivity. Well, the issue we have when we talk about Puerto Rico is there's not a lot of inflation, the population is shrinking, and companies are leaving. So you don't have the price variable working much for you, you don't have population growth working for you, and you don't have the investment from companies since taxes changed several decades ago. And so really it's going to come down to the numerator, taxes and spending, the debt part. You can have whatever size institution, government, in this case, you would want, but you're going to have to pay for it. How will you pay for it? Well, I would say there's three things you could tax. You could tax income, which is what the economy generates this year. You could tax wealth, which is the sum of all prior income. Or you could tax transactions as people exchange income and wealth in the economy. And if you think about the US, we have all three types of taxes. We have a national income tax. We have property taxes at the local level. We have sales tax at the state level. So we have income taxes, wealth taxes, and transaction taxes. When we think about a territory like Puerto Rico, the question is the burden so large that it becomes self-defeating? And we've seen this in the Euro area recently. One of the more compelling studies from the IMF recently has been one that questioned fiscal multipliers, especially as interest rates become low, or in some cases zero, or in some cases very recently negative. The assumption was if you're trying to deal with debt, you can take fiscal austerity because if you do it, interest rates fall. So if I have a lot of debt and I want to raise taxes, cut spending, that's okay if I can finance the rest of my debt cheaper. But if you're already at the zero bound and you try austerity, it sometimes doesn't work. This has been the experience recently in parts of Europe, and I think some similar criteria could apply to Puerto Rico as well. And so fiscal multipliers might be a number that instead of 0.5, so if you cut $1, you only lose 50 cents because you can refinance at lower interest rates, that number could be greater than 1. If you cut $1, you could actually lose more than $1 in the economy. And if fiscal multipliers are greater than 1, and that's been the experience in parts of the global economy over the last several years, it's really hard to see that as a way out. And so we're in this situation where you have debt to income as a question mark. The ratio has to go sideways. It's difficult to operate on the numerator, debt, if you cannot pursue some sort of austerity or if austerity is self-defeating. And it's tough to see how you operate a lot on the denominator given the constraints that we talked about. This is not to say that there are no bright spots in the Puerto Rican economy, but I think we have to pick our spots. We have to be careful. And I think for investors, you have to do due diligence on projects. Not all the debt is the same, even though it could get painted with the same brush. Some is insured, some is not. But that type of active analysis is necessary to get a handle on what is going on in this type of economy, given some of the 50,000-foot constraints.
Don, thank you. As you note, there are many different types of debt in Puerto Rico under many different kinds of conditions right now. Michael will bring us up to date.
Great. Jill, can we put my slides on? Thank you very much. Oh, great. Thank you. Do you have the clicker? Thanks. Great. Well, Puerto Rico, very important topic right now in the muni market as far as our assessment of risk and relative value. We know that the market itself is very connected with Puerto Rico, and so what I'd like to do is just talk about the economy in general and break down into the finances of the government. And so when we look at Puerto Rico, I'd like to look at it as sort of a tale of two different cities, although not cities. So you have the health of the general government, and you also have the health of the economy as a whole. And when you look at the two, you really get two different stories. I find that the private sector is doing very well. You've had pretty solid job creation. Manufacturing has fallen off in line with sort of the rest of developed countries, service-oriented countries like the US. But overall, employment in service industries like utilities, retail trade, wholesale trade is doing very well. The government, however, is not. So with that, let me just go into my slides. As you can see, private sector employment has stabilized since the recession. You had this period in 2010, 2011 where Puerto Rican jobs were kind of sort of range bound. They popped up a little bit there and have kind of stabilized. You look at, in contrast, the government sector, which is a very large percentage of the Puerto Rican economy, I think 40% of output. So the interdependencies there are quite large, but the private sector itself faring relatively well compared to the government. And then with the service sector within the private sector, you have manufacturing and you have services. Manufacturing has just gone sort of tumbled, really starting in the mid-90s. Puerto Rico established itself as a pharmaceuticals manufacturing hub in the 70s and 80s as the US government created these incentives for drug manufacturers to produce drugs there, tax incentives to wean it off this sort of sugar export oriented kind of farming agricultural economy. And since the 1990s, when those incentives sunsetted and the tax code changed, manufacturing has really taken a tumble, while the service sector has actually done pretty well, especially during the late 2000s, as you can see, leveling off in the past few years. Housing market is pretty good. You look at the median value of owner-occupied houses in Puerto Rico, coming up in line with what happened in the U.S. economy in the 2000s, and then now leveling right now, starting in 2010. So Puerto Rico is interesting. It's sort of correlated with the U.S. as far as economic growth goes. However, it isn't. Puerto Rico has been in a recession since 2006. So it's important to keep in mind the similarities yet the differences between the U.S. and Puerto Rico. The U.S. is a federalist system, many layers of government, state, local, federal. Puerto Rico is very much a centralized government. And so if you look at the population pyramid in Puerto Rico, men versus women, it's very much box-shaped. And I put that it resembles Western Europe and Japan. More so Western Europe. Japan, as you know, is inverted in a sense that it looks like an upside-down pyramid. You have a very low fertility rate, aging of the population, and the population is actually declining in Japan. Puerto Rico, it's pretty consistent. And if you look at the large number of people in the the low amount of people in the retirement age, basically from 69 to 85 plus, versus the number of births on the low end of the pyramid, you can see that as far as funding of pensions and OPEB goes, when the 15 to 19 cohort enter the labor force, you're going to have those costs of the baby boomers retiring spread out over larger populations. So I think that's a pretty bullish signal as far as the overall economy, the economic growth, and the ability to grow the labor force over the long term. As Don said, participation has been decreasing for quite some time because of the drop in manufacturing, but as far as the population growth goes, things are actually not as bad and not as dismal as they seem, at least that you would get from reading, say, the New York Times or any other, not to single out the New York Times, but just publications in general talking about the sort of the bearishness and how things are bad on the Commonwealth. If we look at debt to GDP, so that's a number, if you read and follow headlines on Puerto Rico, a lot of people talk about, well, debt to GDP is high relative to US states. Currently, debt to GDP is 70%. What a lot of people neglect to mention as far as that goes, if you look at the average state debt to GDP in the United States, it's around 5 to 10%, so small. But Puerto Rico, it's kind of an apples and oranges comparison. Puerto Rico has all of its services provided on the highest level of government, the Puerto Rico Commonwealth level. There are municipalities, but as far as provision of services, Medicaid, social welfare programs, they're all done on the Puerto Rico level. Puerto Ricans don't pay federal income taxes, they just pay state income taxes. And so if you look at the debt to GDP, adjusting for the fact that Puerto Rico does not pay US federal debt and therefore it is not a burden, the US federal debt is not a burden on Puerto Rico citizens, and if you adjust state debt for the burden of federal debt, because people who live in, for example, Florida will be paying Florida debt service out of their income taxes, you find that Puerto Rico has the lowest debt to GDP of all the US states. So if you put it on an apples to apples basis, the Puerto Rican debt burden isn't as large as one would initially think. So Puerto Rico, like I said earlier, is very much centralized government versus the US state, the US federal government model. And that really has its roots in Spanish civil law. If you look at the history of the island as a Spanish territory back before the Spanish-American War. Liquidity, if we break down to the financials at the government level, the big question is, are they going to default, which they have already? What is the outcome going to be for investors? Really, there are three ways to look at it. If you look at liquidity, so liquidity is pretty low. Liquidity, 40 days cash on hand, right? So they can pay 40 days expenses without taking in more money is essentially what that says. Versus the US state median of 120. We've heard the headlines about all the debt coming due. 2014, Puerto Rico has to sell $3.5 billion of debt to refinance a lot of its short-term variable rate termination payments it had to pay out to dealers for downgrades to junk by the ratings agencies. And so liquidity continues to be a problem. And it's very much pick up the football and punt it and then, revisit in a year. They've issued a lot of tax anticipation notes, basically commercial paper, to really shore up their liquidity situation. the last few years. And the real risk with that is, are they going to be able to roll it over continually into the future? So that's something that we watch pretty closely from the investment standpoint. And a lot of people ask, okay, so how much money is Puerto Rico losing on an annual basis, revenues versus expenses? So at Cumberland, where I work, we've done the task of, let's consolidate all the government entities and let's figure out total the revenues of those entities that could feasibly use to be paid out bondholders versus the actual expenses. And so I talked about Puerto Rico being a centralized government. You know, you have the power authority, the water authority, the highway authority, the university, and every other government. But if you fold up the tax-backed debt, which is the GO debt, right, coming out of the general fund, its main way of accounting for revenues and expenses, and you add all the various flavors of debt, if you will, the sales tax debt, the appropriation-backed debt, into which will be lumped together as far as a possible restructuring goes, you find that revenues, I just put it up on the top line, about 1.17 billion from all those entities together versus expenses. And so we have a $5.3 billion financing gap every single year. And then if you see right here, I adjust down the financing gap for non-cash expenses and also debt servicing. And you get around 2.5 billion of budget that needs to be shored up from bondholders. So that's something that over the next 5 years is going to be watched by the market, and in our opinion will likely have to come from bondholders, or at least that's what the general notion among the marketplace is. But there's slightly a rosier story. So one thing about Puerto Rico is that it has very large cash economy. The gray economy is estimated at 25% of output. So I've taken this slide actually from comments from MBIA's CEO, the COO of Assured Guarantee. And basically what he said in his last earnings calls was that 56% of sales taxes are collected. And if you collect 100% instead of 56, you get another $1 billion in revenue. Now that's obviously overly optimistic, but that's about a third of the amount needed to plug the annual financing gap. So overall, collections, if they increase, Puerto Rico could stabilize its fiscal condition without impairments to general government creditors, so GO creditors versus sales tax creditors and all the other creditors types on the island. Puerto Rico is very much a hodgepodge of different types of bonds, but the GO bonds, which are the main bonds that have that constitutional protection that a lot of people think aren't going to be as impaired as, say, leaseback bonds and other bonds in their capital structure, those should fare pretty well. So just getting to the point. So a lot of people talk about Chapter 9, U.S. IRS code for dealing with bankruptcy not extended to the island. There's no legal framework in Puerto Rico to file for bankruptcy. That's a problem. We saw what happened with Detroit, where it led to basically all these different creditors, hundreds of thousands of creditors, thousands of creditor types rushing in to sue the Commonwealth, and then the only resolution mechanism was Chapter 9 bankruptcy. You don't really have that in Puerto Rico, and the problem with that is that Puerto Rico is much larger than, say, Detroit, 70 billion, 73 billion in outstanding debt versus around 17 billion for Detroit. So passage of Chapter 9, just deciding whether or not they're eligible to file for Chapter 9 could take years, which is a common theme we find with municipalities to begin with. So, we saw this with Harrisburg. The city tried to file for bankruptcy over the course of 2 years. The state eventually stepped in, said, no, you can't do that, and the state ran the process. So maybe we get some sort of resolution similar to what happened in Harrisburg with Puerto Rico. And then we know what happens with entities who file for Chapter 9. The cost of capital drastically increases, and they lose credibility with the marketplace for decades to come. So Chapter 9, by all means, not a panacea, not a get-out-of-jail-free card, just something that is the absolute last resort. So government dysfunction. So the Commonwealth itself isn't so much the problem as is the government in the Commonwealth. So there's been a recent shift in support by the governor for honoring the debt. That's sort of a sign, kind of an indicator of the sort of taste of what the government wants to do. There's a credibility crisis. They've said they're going to restructure over the course of the past year now. A lot of people have said that, or at least the government has come out and saying that the debt is not payable. They tried to sell $750 million in debt about a month ago, issued by the Water Authority, which was the most secure revenue stream in the Commonwealth by most measures, and they weren't able to do it, even though it's legally separate from Puerto Rico's government. So overall, there's sort of a liquidity crisis, sort of a credibility crisis that's going to need to be addressed. And then I just showed, is this the last chart? Okay, hold on. So spreads remain elevated. So you saw a pickup in yields on Puerto Rico debt relative to the AAA benchmark. This is our way of gauging risk in long-term Puerto Rico debt, starting in 2013 with a Barron's article released that spooked retail investors. We talk about the retail component in the municipal bond market, very large percentage of the buyer base. S&P downgraded to junk at the end of 2013. The muni market is very much a sentiment-driven market. You have the initial restructuring plan proposed for government agencies last year in June, and then, let's see, what does that last thing say? Right, and then the Puerto Rico governor says that the debts are not payable, and that caused a spike in yields if you look at toward the end of the chart right there. So in closing, the healthy economy, I think, is better than headlines would suggest. Housing values are doing pretty well. Manufacturing is declined, but that's a theme everywhere in Western economies, especially with China and all of these other economies who have central bank independence and can devalue their currencies. Puerto Rico, US dollar-based, doesn't have that option. Liquidity and debt crisis on the government level, we think can be solved. Higher tax collections is sort of the silver lining and the problem, or excuse me, the solution. Chapter 9, not a solution, and we'll take it from there. So that closes those are my thoughts. Thanks.
As we mentioned, the Puerto Rican government is in Washington today explaining many of these same facts to the Senate Finance Committee. What we've heard so far from Washington has been somewhat skeptical. Chuck Gabriel is going to give us the Washington take on what might be done.
Yeah, hopefully explaining it like nuclear power to a cat, as we like to say. It's very complex, but half jokingly, given what's transpired with Speaker Boehner since Friday, I'm tempted to yield back the balance of my time. But
Just don't resign before the end of your presentation.
But I do agree with my friend Michael Zezas that the challenge just got much harder. And there are really very sharp differences in views in Washington. The Democrats want to give Puerto Rico the sovereign right to declare bankruptcy. They're open but less enthused, I think, about a governing board from what I've detected. And they support entitlement reforms to reduce deficit pressures from the current treatment of claims under Medicare and Medicaid, plus the SSI program. House Republicans, on the other hand, have no particular interest or sympathy in Puerto Rico. They don't have a vote in Congress. The congressional districts that are heavily, that have a heavy component of Puerto Ricans are overwhelmingly Democratic. They don't have any electoral votes, as I mentioned. It's interesting, on CNBC this morning, the likely next speaker, Kevin McCarthy, made some comments, and he essentially commented that about 60% of the House Republican caucus has been in office less than 10 years. So another element of this story is that they don't have any shame or deep knowledge of what happened between 1976 and 1996 with the big turnaround on 936, et cetera, and they're very conservative. In the Senate, by the way, there are no Republican co-sponsors for Senator Blumenthal's Chapter 9 bill, just as the case with its analog in the House. And if you really want to look at the essence of it, Republicans have an aversion to anything that can be labeled as a bailout, and I know that doesn't come as any surprise to any of you, given the politics since the financial crisis in Dodd-Frank. They're also sympathetic to investors' interests. The House Capital Markets Subcommittee held hearings in the last Congress on how the Obama administration sided with Argentina and against shareholders, investors at the last Congress. I thought that was very interesting, and some of that kind of continues. And then we've seen a proliferation of what I would sort of call front organizations, but seniors advocacy groups designed to defend all the anti-bailout interests of average investors who allegedly would get hurt. And now you've seen a counter article written, I don't know if you all saw that, that was really something, saying that hedge funds should have known better. Everybody's in the game, and I just a comment that my partner Jim Lucier, who's also like me a Dave Kotok friend, likes to say, it's not just about a bill, it's about billable hours. So we've got a food fight that's sustaining everybody there, and different opinions about how bad the Puerto Rico situation is. My bottom lines are, Republicans see Title IX entitlement reform as a bailout, pure and simple. But I think they might eventually be willing to consider a control board if it were to be accompanied by pro-growth economic reforms, and that's a big if, and it could be a tough swallow for a lot of the Democrats. Senate Finance Chairman Orrin Hatch has pressed the idea of a sub-minimum wage, but tax cuts and other plans that could hold Puerto Rico up to the light as a pro-growth model or incubator. That's always very attractive to Republicans and could represent a lure for a future deal, I would say. A columnist in The Hill this morning actually wrote a column and compared the situation with a control board we had in the District of Columbia. And the control board had actually became very popular in the District of Columbia. And it reminds me of particularly back when the Republicans thought they were going to take over for a generation with Newt Gingrich. One of the seeming paths out of the district's own nightmare in Washington has been the concept, a nightmarish relationship with the government, I should say, has been to become a massive enterprise zone or low tax haven. So I think that there's that prospect potentially, but it's going to take time for the right conditions to emerge for that to happen. At any rate, I think that we're probably seeing some evidence of that in the Senate finance hearing that Mike mentioned today. Include testimony from Mr. Perluisi, is that how we pronounce it? And a member of the Puerto Rican Working Group. Particularly interesting to me and to our firm will be the testimony and response to the economist Douglas Holtz-Eakin, who's a longtime friend. I think he was an advisor to John McCain, so some of you may remember him. His American Action Forum has some mind share among conservatives, I think it's fair to say. And he suggested in the past that bankruptcy reform might not be evil if combined with with major reforms. So that's going on right now as we speak, that hearing. And then one other thing I just would mention, one of the other backdrops for the hearing has been an exchange of letters between Senator Hatch and Treasury Secretary Liu in the last couple of weeks. And Liu wrote back that without helping, we'd only drive more Puerto Rican reliance on transfer programs and more of an economic death spiral, and we'd hurt retail investment portfolios. It's interesting to see Liu himself sort of walking into that debate when the others on the other side have tried to use it to their own advantage. So I'd say the White House at this point, from what we see, seems interested but not committed. That's a famous John Boehner joke I used to love. He'd be at a fundraiser and he'd point down to the bacon and eggs, and he'd say, well, friends, let me tell you about the difference between interest and commitment. The chicken is interested, the pig is committed. So I think the White House is interested, not yet committed. And that raises the question then, what lies ahead? If you're following our great follies in Washington, the Senate passed a procedural vote late yesterday to probably move to final passage today of a continuing resolution that funds the government through December 11th. The House will follow suit. Speaker Boehner will absolutely walk the plank with Democratic votes. We'll pass that by tomorrow, and we'll avoid a government shutdown. Meanwhile, from what I'm understanding, and I wish I could have heard some of the earlier testimony this morning, or the comments this morning, Puerto Rico is saying it will run out of money in November and could default on debt, or at least there's that threat, in December or January. And so the question really is, does all of this suggest the potential for Congress to act? And I think there are two things to watch, two key junctures or opportunities for action near term. I think it's a pretty tough haul for either one of them. but just to let you know what to look for. With Speaker Boehner leaving October 30th, there is also a simultaneous October 30th deadline to reauthorize the Highway Act, or at least to fund it at that point. And it does create an opportunity that's gone much unheralded in some of this press coverage in the last few days, that you could see an effort, one last effort, while Boehner's still in office, to try to do some of the dirty things that will be very difficult for Mr. McCarthy or that House Republicans frankly don't want to take a vote on anyway. So there might be an effort to drag things like Ex-Im Bank reauthorization. I think the place will go nuclear if that happens, and that's one of the reasons I'm still skeptical of this, but there is an inflection point at the end of the month for the highway bill, particularly if there's a pay-for it or a set of offsets that involves taxes. And it's interesting, you have Ways and Means Chairman Paul Ryan, who we all know has got tremendous street cred within the party. He has actually proposed, and I think he's walked it back a bit now, but he had proposed that we have some corporate tax reform in the form of repatriation that would pay for a long-term highway bill. I think that's mostly off the table, but if you get into any kind of discussion about a tax-related pay for a highway reauthorization, Highway Act reauthorization that could go from 3 to 6 years, that creates an opportunity, since you're talking about the tax code, to potentially do something for Puerto Rico. But I have to say that, again, that's less likely because I think Ryan has walked it back. It's also probably too early in the dance between creditors and Puerto Rico's government and public corporations. Just the way Washington is, you need more time to show pain. We need more of an imperative to act. Frankly, a market crash, a muni market contagion, and I hate to say that around these guys, heaven forbid, that's the kind of thing that we might ultimately have to see action in Washington. That's just the way it operates. And of course, shareholders are trying to raise the threshold for anything like that, perhaps as a means to either forestall haircuts or to increase their leverage in the debt negotiation. So that's the first thing to watch at the end of October. There's potential. I'd say that's like 10 or 15% prospect, very unlikely, too early. This hearing this morning, unless you have surprise kumbaya type moment at this hearing, I seriously doubt that. And then will come a very, very turbulent period in mid to December, and frankly might begin pre-Thanksgiving, because Treasury Secretary Liu, even though you have experts that say that the X date for the debt limit suspension, the extraordinary measures that allow Treasury to buy room under the cap by deferring investment in trust funds, the experts think that that's essentially, we have an X date that should be perhaps just after Thanksgiving. But Treasury Secretary Liu, frankly, that X date will be wherever Treasury Secretary Liu says it is. And if he wants, he can drag that forward, he can drag it back, just to strategically sort of throw the Republicans off balance. The assumption has been that ultimately that would be wedded together with the need to pass the omnibus appropriations bill at the end of the year, and maybe the highway bill, and forces a grand bargain. And the White House, I think, feels that he can move things on its terms. But nevertheless, the point is, we're heading towards a very, very messy Thanksgiving, December. Yet another wall of worry. My good friend, Dr. Yed Yardeni, who we worked with at Prudential, has pointed out that this great bull market that's lasted since, June of 2009 has been built, the equity market, has been built on one wall of worry after another. So we're probably in the middle of one wall of worry now, and we'll have yet another by December with another tiny little fiscal cliff. But all of this has led us to raise our threat warning from a 3 on a scale of 10 to a 4. And with the 2011 episode where we had the debt downgrade, and that came amid the Greek and European debt crisis, that was a 10 on a scale of 10. Fiscal cliff in 2012 was a 6. We had a 16-day shutdown in 2013. That was a 3. We had the Murray-Ryan budget deal that gave us a 0 in 2014. They took it off the table. But now this kind of takes it back up to some risk. And it's if with the Boehner move, we're likely to see some a leadership challenge and a vote probably in the next couple of weeks. And if the Republican caucus in the House moves to the right, then those negotiations in December can become very, very difficult. There are a lot of interests that want a big omnibus deal at the end of the year. And that's just not Democrats in the White House, obviously, but also Republican hawks, defense hawks who want higher defense spending. And one of the more interesting factor bets that my institutional clients have been watching has been the concept that Republicans will get some kind of quid pro quo, and perhaps what their ask would be some additional Dodd-Frank reforms, perhaps in the form of a provision that would raise the $50 billion threshold on designation of regional banks with $50 billion in assets or more as SIFIs, systemically important financial institutions. There are about 24 banks that would get, capital relief and wouldn't have to go through the worst parts of CCAR and other things like that. All of Wall Street's been watching this potential story while we've been waiting for the Fed to finally raise interest rates and to get some net interest margins, win back in the sales. So there are a lot of people who want a bill, an agreement at the end of this year for all kinds of reasons so that it could become a vehicle for a lot of agendas. We've been skeptical for precisely the reasons that we're beginning to see things, kind of fall out. So a couple of last points. Why are we skeptical about a broad bill that might give a broad vehicle to perhaps allow some work on Puerto Rico or some provisions? Raising the caps will be a very tough swallow for Republicans, certainly even more so post the Boehner move. And meanwhile, there will be Plan B measures to vent the party's hostility toward Planned Parenthood. They'll have inquisition-like hearings, and there'll be movement of a reconciliation bill that would defund Planned Parenthood, although Obama would veto it. But none of that's going to satisfy the conservatives. So that issue is still waiting for us at the end of the year, making it very difficult to forge a deal. And the last point is there really is no Murray, there's no Patty Murray or Paul Ryan to negotiate a deal. The new chairman of the committee are Mike Insee and Pete Sessions. It's not a very good replacement. That doesn't mean that Ryan couldn't be tapped or conscripted to get involved, and if he does, that would be a very strong positive. Not only does he have the sway to actually move things, he's now chairman of Ways and Means, and it's the Ways and Means Committee that has jurisdiction over the issues we hear about here today. So I strongly doubt that anything that we might do can include Chapter 9, but perhaps some new tax credits are less likely control board. Maybe that's a very remote possibility and all that. And lastly, I would just say, even though Republicans might be supportive of tax reform, and you might think that would be a positive if we have a Jeb Bush or a Rubio administration, on the other hand, you still would have whoever wins the White House will also take the Senate, and you still have Republican resistance to what they think is a bailout. So I would label the Puerto Rican debt as not a blue stock, but a blue investment. We divide the world into red stocks and blue stocks every 2 years, and I think they might be marginally better off in a Hillary Clinton or Joe Biden administration than perhaps a Rubio or a Donald Trump administration. So that's it for me.
Thank you, Chuck. I love the idea of tying the Puerto Rico default into the U.S. debt ceiling. I can imagine Kevin McCarthy with an Australian accent saying, "You call that a default? The United States, that's a default." We've got time for questions. I want to ask two to start, and then we'll open it up to the audience. And I'm going to throw both of these out to all three of you. Probably Don and Michael may be best able to answer this. But just to set the stage based on what Chuck was saying about the need to concentrate the mind here. What's the likelihood of a public hanging? Has the time that this has taken to move to this point allowed the funds that hold a lot of Puerto Rican debt to reduce their exposure, so the idea of a really painful default deleveraging that would force Congress to move, has that moved off the table a little bit? And then I want to twin that kind of with the question, yes, if you're correct, Puerto Rico can make changes that would solve the problem, but in the short run, while those changes are being made, and we know nothing happens quickly in politics, how likely is it that some of these debts go unpaid, and where's the pain from that?
Great. So just to answer your first question, we've looked at who owns Puerto Rico debt pretty closely, and it's changed since 2014 before 2014, it was very much a retail buyer-based play, especially with large mutual funds who had state-specific funds who would buy the debt because it was triple tax exempt. So you'd have a Massachusetts domiciled fund that would buy Massachusetts tax-preferred paper and fill it up with 90% Puerto Rico debt, which was pretty common prior to 2013 when the stuff hit the fan and things got pretty bad. We've seen a much larger institutional buyer base with distressed funds now. So the dealers have marketed the debt as a recovery play. They've actually done pretty well. Those buyers bought in really in mid to late 2014 as the bonds really started trading flat, negative term premia, no interest accrual, as if basically vulture investing on buying bonds for 30 cents on the dollar in anticipation of a 60, 70 cent recovery. Those bonds, especially ones of the Power Authority, for example, hedge funds bought in, I want to say, fall of 2014, fall of 2013 at around 30 cents on the dollar, and now we're anticipating recovery around 85 cents on the dollar. So the funds, the high cost of capital type buyers have gotten involved pretty substantially. There's a sort of an ad hoc creditor group working through the impairment and negotiation process with the island's Power Authority. So overall, I'd say it's transitioned. What was your second question?
In the short run,
Okay.
what happens is there a likelihood that some bonds will not be paid?
Sure. So you've had some bonds not pay already. I mentioned the liquidity crisis in my presentation, 40 days cash on hand. As long as the government keeps shrinking, and the government share of the economy is about 20 to 30% of the economy, actually a smaller percentage of employment. As long as the government keeps shrinking, which is, I think, positive long run, negative short run, you're going to start seeing expenses increase. And this is really not even talking about pensions, because they don't contribute to the pension fund and haven't done so for the past decade. But so yeah, as expenses continue to rise, as people leave the island, you're going to have much larger financing gap, and that's obviously not positive. So I think creditors will have to take a haircut for sure.
Michael, I might just add, clearly there's some short-term risk. What I think time has done is three things. One, create the bailout fatigue that Chuck talked about. The second is allow for political volatility. So you have an administration that turns over quite frequently. Economic volatility would normally lead to political volatility. So you have Fortunio in, Fortunio out, Padilla in, and so on. And lastly, allow us to get closer to Fed liftoff. So instead of having an accommodative U.S. monetary policy stance, we still have general policy accommodation, but we are raising interest rates, or at least approaching that point.
All right, let's open it up to questions from the audience. We start with the front row.
How does the issue of Commonwealth versus statehood play into either of your assessments of what might come out of this?
Well, I think from my point of view, it is on the border. So it says maybe you could have something that's going to function more like a state government plus a local government. And that's where Michael talked about some of the combined spending issues. We have to be careful about what we lump together when we're seeing what is spent, because certain services are provided at the state level versus provided at the local level when we consider continental U.S. states. But the question it brings up for me is really, should you be part of this monetary union or not? You don't have to be. And you don't have to have U.S. laws apply if you went for some sort of independent path. So being half in has some benefits, like defense, but it has some cost, meaning you can't use the currency lever. You would not have some of these other tools available where you can deal with debt in those type of ways. Also, minimum wage laws apply, and you have some ability to get by if you can get, say, food stamps. So you can have a crisis averted, but perhaps not a very good living standard in that type of scenario.
I just got to say, I think about two senators from the state of Puerto Rico, and I just kind of chuckle. I mean, the notion that Republicans would go along with that, I know it's probably, there are all kinds of ways that you could perhaps try to finesse those concerns, but the District of Columbia has had the same issue for a long, long time. They've wanted to become a state, and we'd have to try to figure out a way to get around our Constitution and the impact it would have on the balance between the two parties right now. And the ones that it would hurt have the controlling balance in the Congress right now. So, I think you'd have a big pushback there.
Other questions? Yes, sir.
This is for Mr. Combs. Okay. If I understand you correctly, you're saying that you anticipate there's going to be a $2.95 billion annual financing gap?
Yes.
All right, so you also said, you mentioned that Assured Guarantee has estimated that if sales tax collections went from 56% to this hypothetical 100%, that it yield $1 billion more annually.
Uh-huh.
And you've also called for increased tax collections as a method of addressing the lack of money, Puerto Rico's lack of money to pay off the debt. But as you yourself noted, it's unlikely that they're ever going to get to 100% sales tax collection.
Sure.
And certainly there are other ways of things that could pull in more money from the great economy, that is, improved income tax collections. But I was wondering if you could talk to me a little bit about that, because you have a $2.95 billion annual deficit you're trying to plug, and the best, you're just looking at $1 billion, at least from sales taxes.
Right. So we've run the numbers on sales taxes, income taxes, and the various other tax revenues the Commonwealth has available to it. Income taxes are relatively easy to skirt. Sales tax collections are low. I think if you look at income taxes, you could probably add in another $250,000 to it. A lot of and they're trying to make it an economy much more sort of attractive to outside investment and investors themselves. We know Paulson's funds, a lot of his hedge funds have moved to Puerto Rico. They have 0% income tax, I think, on passive income there. So these are all structural supply side reforms that I think they could put in place just to make it more competitive. As Don noted, they don't have central bank independence. How can you be a manufacturing, economy when you're competing with China, who doesn't have minimum wage, who could pay computer developers $10,000 a year, and you have to pay U.S. federal minimum wage. So as far as new methods of tax go, there was a VAT proposal, value-added tax proposal, which is much easier to collect than just, say, a general sales tax. And they could raise the VAT, I think, anywhere from, I think the initial proposal was around 20, 30%. That's still being put on the table. But I think there comes to a point where, do you really want to stifle economic growth with ever-increasing higher levels of taxation? They've done a lot of downsizing in the government. Right now, more and more of the government's resources are just being used to service debt. So it's almost a social issue. I mean, do you really want, for example, as in the case with places like Chicago or even Rhode Island, there are towns in Rhode Island where 50 cents of every dollar of taxes collected are used to pay debt service, and 70 cents of every tax dollar collected are used to pay debt service and pensions. So do you really want to collect taxes to pay for services provided in years past, paid for with debt? And politically, that doesn't sell well. So there comes a point where just the general populace has an aversion to debt, and solutions like higher taxes just become unworkable because of the large burden. I know people who live in Puerto Rico, and they have water rationing. even though there's plenty of water to go around, but the utility itself is just, they have power rationing. I mean, it's, these are all problems that are fixable, and it seems to me that just paying higher debt is really not a long-run solution. Now, in the short term, there are solutions, and as far as a bondholder perspective, looking out in the next 1, 2, 3 years, I think that you're right, they could rely on some sort of short-term interim financing, but we do think there's still going to be a haircut, some sort of restructuring in the near term.
We have time for about one more question.
Given that this seems to be a political solution more than anything, what is the probability of a reconciliation between, let's say, a reinstatement of a 936 type legislation with a restructuring of the debt? Would both sides be amenable to that kind of a compromise?
What I was trying to say in my comments earlier is, in Washington, timing and legislative vehicles really matter. And, that's the kind of thing that can, I think, really only happen, not through a regular order, unless you have an absolute real meltdown, and it doesn't seem like we're anywhere near that. So this is the kind of thing that would have to be folded in to tax legislation and probably, broad comprehensive tax legislation, tax reform legislation that's just not going to be on the table in 2016. So you've got these two bites at the apple as we fund the government and we deal with the debt limit, maybe a highway bill, maybe with a tax component in the next 2 months. But 2016 is just a waste because it will be, political messaging and it'll become bitterly partisan. So I can't imagine something like that unless you see a real change in the the current environment right now. I can't imagine something like that till the earliest 2017, and the situation could change a lot on the ground between now and then.
Yeah, I would just add that there have been actual tax code changes done by the IRS through executive order. Act 154 is a big one. Basically, it exempts U.S. companies domiciled in Puerto Rico from paying U.S. income tax, kind of sort of income tax deduction method. Yeah, with the stalemate in Congress, I agree with that.
I would just say that I think that one of the interesting sort of subtext of today's hearing was that from what I read in Hatch's opening statement, he seems to kind of be warning the Obama White House not to do anything administratively in Treasury, because we've never seen anything quite like. I've been at this business 32 years, as Mike said in my intro. Never seen an administration that lost the midterm election cycle so badly and came out, becoming, instead of having the decency to becoming a lame duck, came out swinging for the fences, regulating the internet, freezing deportations, restoring relations with Cuba, free community college, 40% cut in FHA premiums. So, if they decided to do something along these lines, who knows? Look at what Treasury did on inversions. Yeah. You have a very good point. They could do something. And if you look at Hatch's opening statement this morning, I think he was sort of sending a veiled notice, we should be consulted on anything like that.
All right, well, we'd like to thank our panel today, and then we'll get out of the way so that David can reserve a room for the big debate over what to do when the federal government defaults. We'll have Chuck back in December.
Stay. I'll only be 3 minutes. Thank you very much, panelists, sponsors, supporters, especially Strategas, who helped put this together and host us. Books will be at the registration table for sale for $20. That's a bargain. I'm not sure it's a bargain, but it's cheaper than you can buy a used book on Amazon. And the proceeds go to the Global Interdependence Center. The books are donated by Cumberland. Let me just add 2 things. Slides, I forgot, slides. GIC website, and some people have given Jill business cards. And there's a program in the back of the handout that shows all of the other GIC programs that are now set around the world. You're welcome to be a part of them. The Global Interdependence Center started in 1976. It is a neutral convener of dialogue. It assembles, discusses, and then the takeaways are for us to use. I would just add one other point, or two perhaps, one for Chuck. And I thank him for coming and joining us today. It's the first time you're with us at the GIC. All the rest of us are veterans, but this is your first. We've had Lou Sear so many times, we actually recognize him. But thank you for making the trip. Thanks. Yesterday morning, the whole conversation today is on municipal debt. We've talked about Puerto Rico, the poster child of the moment. We've talked about the cities, and we've talked about our munis, rich and cheap. So let me just share something for 3 minutes. Yesterday morning, I was at the BCA conference at the Hyatt, and the first hour was with Ben Bernanke. In the conversation, which was very wide-ranging, there was a little indication, a little gem, which came out. In the discussion or a question about negative interest rates, which are now in use in Europe, and the use of them is expanding, Bernanke said, in response to a question, that he thought about them in 2008. And determined at the time not to use them because he was worried about the damage it would do to money market funds and the banking system in 2008. At the same time, everything else was evolving systemically. Implied but not stated was why Trichet didn't use them. Now, fast forward 7 years. He was asked what he thought of them now. And the answer was, they seem to be working in Europe. That is a very profound insight in a 7-year change of view. Now, he's after the fact, he's no longer the chair, and he is expressing an opinion as a private citizen. But he was very candid about the fact that he did think about them 7 years ago, which would suggest so did Trichet. We now have spreading negative interest rates. In a subsequent discussion, thanks to Martin Barnes and the BCA dialogue, Bernanke was asked about the size of the Fed's balance sheet and the use of tools. And he was very clear about how he answered. He said, we now have a whole new set of tools. The size of the balance sheet, as he put it, can go up and down. It's very interesting, up and down. The composition of the balance sheet can go long and short, which means the duration can change. He said, and independently, we can move the interest rate, short-term interest rate, up and down. Now, there's an interesting delinkage of three things. And lastly, he said, and if he was asked, well, will the Fed be in a dilemma if they raise rates and then turn around and have to reduce them again, especially so close to zero? And Bernanke said, to paraphrase, because I don't have those exact words, he said, that's silly. It's a foolish question. And as for where rates will go, we can put them up or down. And now we have negative rates if we need to. I found that takeaway remarkable in a world in which negative interest rates are spreading. And where a study by Haldane at the Bank of England talks about the possibility that the interest rate could go to -5. And the thought of that. So in our view, John and I have been talking about this in the last 24 hours. When you think about a high-grade tax-free bond at 130% of a treasury and the Treasury relatively restricted in supply, and in the deficit discussion implied in this panel. You might say, in a world of negative interest rates, what did Joe Mysak say? Munis may possibly be interesting. So on that note, thank everybody for coming. We hope you enjoyed the morning. Thank the panel. We'll sign the books, Jim.